Hey everyone, we've had an overwhelming amount of questions over the past 12 hours or so from not only clients but also the general public about what's going on. Is this the next leg lower in equities? What's going on? So I thought I would make a public video and really share what I'm also telling clients here today. So let's flip on over to the charts, and we're going to look at equities and give you sort of a fairly detailed analysis on the S&P through the lens of what it means in the bigger picture, which takes other things into account as well. But I want to quickly start off with bond yields. And what this is here is the 5-year U.S. Treasury yield. And you can see, if you look at this purely through the lens of technical analysis, but also psychological analysis, I mean, this really does look like these yields want to go lower. We had a rally in yields over the past week and a half or so, and then we're right back on support. So I personally think when these yields start breaking lower below this threshold, I think that's going to be another warning sign for people in the risk on sort of people who are bullish equities and things like that. You can also look at 10-year yields here. This doesn't look a heck of a lot different. You can see more or less different technical formation, if you will, but again a right at the upper end of the trading range, and now it looks like we could maybe it takes a bit more time, but we could ultimately break below and really start heading towards maybe 30-20 basis points in 10-year yields, which I think would be really an alarming thing for the equity market at some point, which gets us to equities. And so I want to start on two things. First of all, I want to quickly start with Apple before we look at the S&P 500. I know and this is kind of cherry picking on just a couple of very big things, but I do think it gives you some perspective. So this is Apple's chart stretching back to, let's call it 2011, where it goes back much more, as you can see here. But I think I'm gonna move this here over on this side, and really, if we zoom in a bit closer, you can see we had a massive breakout of the long-term range in January, February. Then we reverted into the range, and then we had another very, very sharp rally off of the March lows, and we're now reached the upper end of even that ultra steep range. So I think that's very concerning. If you go in a bit closer on Apple, you can see we have this yellow moving average here, this one here that I'm following along with the mouse. That's your 21-day moving average. A lot of things over the last few days with the recent sell-off have now reached, some things have even breached below the 21-day moving average, but Apple actually hasn't gotten there yet. So I think that is an attraction point that the stock has to get to, even if it wants to continue going higher. And as of I'm recording this here right now, early Friday morning, June the 12th, we're looking at another 4% of downside, which doesn't seem like a whole lot, and it really isn't. From a mean reversion perspective, that's kind of what I think would be the minimum that has to be achieved. You could also make the argument that if you just draw a very simple horizontal line, and I try not to do that too much because it's overly simplistic, but even for that, to get back to this point, that roughly would coincide with that 21-day moving average. So that's to kind of give you some perspective. Now let's move on over to the S&P 500, and this is kind of where what I just mentioned comes into context. So first, let's actually zoom out a bit and show you where the S&P got on this most recent rally off the March lows. You see we overshot January, February, undershot in March, February, March, and we're now right back to the upper end of the long-term trend. So without overshooting, we kind of should be finding resistance here, maybe for good, or at least for a very long period of time. Maybe, right? We don't know. So there's a lot of factors we have to take into account, and I'll talk about the Fed here in a minute. But this is kind of where we are right now. If you look at this on a weekly basis, the week here, as I'm recording this, is not yet over. We still have 1 week, 1 day of trading as I'm recording this. But so far here, we do have an outside candle, a bearish outside week, just so you know. Now let's zoom into the daily chart, and this is where we can get back to that 21-day moving average that I talked about earlier. I'm going to get rid of the 8-day moving average because that's a bit too aggressive for this. But the 21-day moving average, you can see time and time again, it offers a good reference point. It's not perfect, but it does offer a good reference point. So you can see, for example, once we broke below there in February, it was off to the races lower. Once we broke above it in April, it was off to the races higher. Then we had a little bit of a shakeout breakout here. But you can see what's happening here is once we reached this point here a few days ago, we've now very quickly reverted back to the 21-day moving average. Right? It doesn't mean that we have to collapse from here and see this movement, although the price action into the past few days before the sell-off is not that different from what we saw in January, February. Just, you kind of see this dip here that kind of looks like this. Then you have this rally, which is this rally. So, and this is, I hate to do this kind of analysis this particular bit, but just so you know. So we'll have to see where we go from here, and that's again, I hate to say that, but it is interesting to note that we've had another thing take place, and that's something that I need to quickly show you on the SPY chart. And this is again the S&P 500 ETF, and you can see we had what's called an island reversal. Now, if you don't know what that is, I'm sure you can go to Wikipedia and figure it out, but I'll tell you quickly as well. An island reversal happens when you have an up gap. Like, for example, we had here on the 5th of June. Then you have a couple of days or a few days of kind of price action up here, isolated. And then you have a down gap like we had there on June the 11th. So these are topping patterns. And you can see we kind of had it here too. We had an up gap on February 5th. And that's actually interesting that we had it also, and then on June 5th, that's 6 months later. And then we had a down gap on February 24th, which kind of looks like what we have right now. Now, again, I'm not saying we're going to have this, although I think, quite frankly, from an economic reality perspective, there is a good reason to see this again. But I think, and this guy says to the Fed, because of, and it's not just the Fed, it's a Treasury and all the government, everything that all the stimulus packages and things like that that's going on. I think because they've basically backstopped the credit markets, I'm not quite sure the equity markets have it in them to have a big risk-off event in a one-directional, as quick, I should say, as what happened there. We could certainly go lower. We can retest these lows. We can take them out. We can take them out by a lot. But I'm not quite sure it's going to all happen in a really big, sharp, like 2-week sell-off like we had here. I think it'll take more time. So we could see backing and filling, then a few up days and down days again, then a few up days, and that kind of much more choppy and taking longer than what we had here. So all in all, from right now, from what we've seen, we have to take. I have to respect the price action, which to me would offer that if we go, and I'm going to go back to the actually S&P 500. I would offer that anything around 3,200, so 3,200 or thereabouts, would offer a pretty significant technical resistance. So that doesn't mean that we have to, again, like I said before, completely collapse from here and go lower, but it would offer to me that maybe we've now seen the highest that we're going to see for the summer. This is now, it's early summer. It's the first half of June still as I'm recording this, but that kind of would be where I'm seeing. So we would have a choppy-ish kind of summer, maybe within the range of as low as 2,200 to maybe 3,200. Maybe the range is tighter. Maybe the range only goes down to say 2,600 to 3,200. So that's kind of how we're operating right now. We're looking at entering some quasi-short positions in the S&P 500. Again, not necessarily making bets we have to fall apart from here completely, but maybe more making a bet that we're not going to overshoot above 3,200 or so. If we were to see significant bullish reversals, if we were to see the Fed and Treasury be able to do something again that would bring another risk-on move into the markets, then by all means we would get out of these positions. But for right now, I do think there's a lot of reasons. Again, we've gone through all the different reasons, or at least a few of the most important ones, why we think 3,200 should be resistance for right now. Again, if that changes, we have to deal with the new facts. But for right now, by the way, for the absolute immediate term, it would not at all be surprising to see maybe a sharp bounce over the next few days or so to kind of make good some of the sharp drop-off that we saw on June 1st. It's entirely possible. But I think really more psychologically, what we're trying to do here is say that, okay, this might be a reference point at the top end of the range for the time being, for the next weeks, maybe months, and then the lower end of the range could be anywhere from maybe as little as, like I said, 2,600 to possibly as low as 2,200 or so for right now. So anyway, folks, I hope this is helpful. If you enjoyed this, give us a thumbs up, like, and Also, we're doing a Toast to Traders event that is taking place Saturday, June the 13th. Going to talk about a special topic, a special strategy that we use. It's actually very similar. Actually, it is the one I just basically mentioned to you. A specific kind of trade that we do to capture a range, if you will. So join us for that, and we'll teach you that. Until then, take care, and talk to you soon.